Welcome to the April 2025 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist here at Motor Capital Management and Research. The title for this month's video is From Wall of Worry to Slope of Hope. So take a moment, please, to read the disclosures. So there were many bricks in the wall of worry that kept investors from embracing the 2022 to 2024 bull market. Of course, this was anything ranging from the recessions to the wars to the elections to deficits and inflation and all these other things. And of course, these are all very legitimate concerns, but the market continued to move higher. The risk gauge continued to remain bullish throughout that period. And so as a consequence of that, we embraced the bull market, even though it wasn't particularly broad. It was still a bull market nonetheless, with the idea being that these things we're just going to keep them on the back burner until the market begins to inflect negatively, and then we'll worry about those things later. And so the idea is that the market has inflected bearishly as of the beginning of this year. And so all those bricks may finally now start to matter. Yet instead of embracing this new nascent bear market, there's a new list that's emerged in support of staying long. And this is what we refer to as the slope of hope. And this slope of hope is what will keep investors invested in the bear market until they finally capitulate somewhere towards the end. And this is the same thing that happened with the perma bears that finally capitulated at the peak of the bull market in 2024. There were many, noted perma bears that finally kind of gave in and became bullish right at the end. One actually said, believe it or not, that you should never really say this in the investment business, but I actually really do think this time is different. And of course, not much longer after that, the market peaked. So for us, our focus is on three things. First, we're just monitoring the data for change. We're not trying to embrace or endorse any particularly bearish fundamental thesis, because if the data changes, we don't want to be stuck and married to those fundamentally bearish theses when in fact the technical data changes. So we're just monitoring the data, and we're going to continue to position in line with that. And as it is right now, the risk gauge remains bearish. Even though we've had quite a rally, it's still in risk off in that short-term time period and below the midpoint of mixed on the medium-term time frame. So that to us is an environment where you can eliminate the prospect for sustainably higher, leaving us to invest for sideways to down. And in that context, we want to get more defensive or bearish or short in that context, the market gets overbought. And if we're longer term investors who aren't really interested in being tactical about this in terms of getting short or raising cash, we would just say that in this environment, as it stands today, we want to avoid chasing the market higher and putting new allocations in at these higher prices. Part of what we're doing then is we're just managing that short exposure. As it gets overbought, we want to increase that short exposure as tactical investors. And as we get oversold, we want to reduce that short exposure and just continue to do that as long as the data overall remains negative. And then third, and just as important as the first two, we also want to continue to identify those companies in groups and sectors and regions around the globe that are displaying stronger relative performance than their beta profile would typically allow in a bear market. So things that are doing better than you would expect them to do while we're in a bear market, because oftentimes that's the way the market tells you what will be the leadership for the next bull cycle. So we want to be very focused on that as well. For now, we have been and continue to target this 54 to 5600 area as a place where we think that there's a higher odds that the market can fail. In these counter trend rallies, oftentimes they can go a bit further than you would expect. And so I'm thinking 54 to 56, but in reality, it could get to 5,800. It doesn't really matter to me necessarily what the level is as much as it matters what the structure is. And I'm more concerned about focusing on the structure as the market rallies to be that line in the sand as to whether or not I execute short positions, not how high we go. And so that's where we things stand for us today. So I just want to walk through an example of how the market transitions from bull to bear, and then I guess back again. But in particular, how the risk gauge helps us navigate these things. So starting in late 2021, this is when the risk gauge began to downtick and get into the bottom half of mix in that medium term, suggesting that sustainably higher is off the table. In the best case scenario is sideways. And then when it began to really downtick, it opened the floodgates to much more of a bear market, which the risk gauge remained bearish throughout all of this. And importantly, when you had these counter trend bear market rallies, the risk gauge remained bearish during those rallies. And then corroborating that risk gauge reading, we also, as the market went higher, we noted that the momentum of the move higher began to diverge as well. So this is just sort of backing up what we already know from the risk gauge. And the way you read this momentum indicator is very common as with other momentum indicators is when the reading gets below the what we call the zero line, which is this line here. You can see it over here, the zero line. When it gets below the zero line, that's the confirmation that you've entered bear market territory. And again, during these bear markets, you can get these counter trend rallies, and they can be quite difficult to navigate. And if you don't have the proper context or the necessary context to understand the prevailing conditions that are ongoing behind those rallies, it's really difficult to know what to do. And in the rally that we had from June to August in 2022, that was quite a rally. It was almost a 20% rally, but the risk gauges remained negative. So we were able to identify that and retain our bearish outlook and actually restore the short exposure that we covered down here. As we look forward to the end of a bear market, what we ultimately look for is that on that final low, the momentum, just like it did at the top, doesn't confirm that low. So that's sort of like the anatomy of a bear market. And now we can see we have a very similar scenario unfolding today where the risk gauges began to deteriorate up here, really began to open the floodgates to more downside in through here. And with that, we see the divergences between price and momentum. We see the momentum indicator going below zero. And so now we are in the throes of really the first bear market rally since then. And on the obvious question here is, what are we going to do from here? Are we going to go continue higher or is it lower? And it's really difficult to know. But what we lean on is the risk gauge. And I will show you is that the risk gauge in providing the context that's critical for understanding how best to behave in this rally, the risk gauge is still in risk off. You'll note that in the Monday's weekly motor report, the risk gauge was here at 9, and it's now upticked to 8. And so the idea is that the market's rallied over 15% off the lows, and we now have 87% of the motor universe is above its short-term moving average, which is the 15-day moving average. So we've had a monster rally, and we've had most stocks participate. A lot of folks would ask, doesn't that mean that the bottom is in? Doesn't that mean that this is the start of a new bull market? We're up 15%, and most stocks are above their 15-day average. Doesn't that mean that's the beginning? That's obviously a fair question, but I think what the risk gauge is trying to encourage us to do is to ask a different question. Shouldn't we be asking, just how bad is it beneath the surface? If we can rally that much and get this many stocks above the 15-day average, and the risk gauge is still in risk off. Just how bad is it? The medium-term risk gauge is still below the midpoint of mixed. How bad must it be that you can rally that much and these things are still this bad? So this is critical context in going forward in the weeks ahead. How the risk gauge responds to this strength in the next several weeks will be critical. It will literally be the line in the sand between whether or not we want to short this market as it goes higher or not. And as it stands today, that's how we're leaning. We patiently want to continue to lean into this market as it moves higher into this resistance zone. Thanks so much for watching this clip of the monthly motor checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video as well as access our most recent monthly motor checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.